Welcome back, everyone. Michael here with Offshore Citizen. I'm going to discuss today what is next for the cryptocurrency markets. So for those of you who've been following, we had gone up to a new all-time high, about $69,000, and then dropped back down to around 55,000 and then up a little. And a lot of people are looking and kind of saying, what's going to happen? Now, it's always super difficult to make any sort of concrete predictions and sort of dangerous to do that. So what I'm going to do today is to look at the macroeconomic environment and give my thoughts on what the risks are, what the timing on those risks might be, as well as the overall macro trend to give you some idea of what things are likely to grow, which things aren't, which things are expensive, which things aren't, and we're going to dive in and discuss it accordingly. So let's do it. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. If you'd like help with the things we work on here, which is international tax optimization, asset protection, forming companies, opening bank accounts, moving abroad, getting second residencies, citizenships, etc., please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message through our websites, offshorecitizen.net and offshorecapitalist.com. All right. So as I mentioned, the tapestry is markets went way up towards the end of 2020, early 2021. They kind of peaked around, I did a video on May 9th, I believe it was, when prices were around 58, 59,000. They'd come down slightly from 64,000, suggesting I thought it was going to go down. It did go down a lot, down to around 30,000, dropped just below 30,000 actually. Kind of hung out there. It was quite a long mid-cycle correction, if you want to call it that. And then prices have since gone up and hit new all-time highs before having a bit of a pullback. Now, is that pullback a sign of like the end of the bull market, as they would say? So first of all, I think it's worth noting that it's pretty normal in crypto bull markets for Bitcoin to experience multiple 30% pullbacks. So in that sense, the pullback is nothing abnormal. One might call it a healthy correction. Second of all, I tend not to believe in the concept of four-year cycles. I think that this is an example of fooled by randomness. For those of you who aren't familiar with the concept, it's basically, just randomly you're going to, if you, do a certain number of permutations, you'll see something that works out. And so, there tended to be around a four-year cycle, depending on how you measured it, for two periods, not really so much on the first one, a little bit on the second and third, depending again on how you measured things. And so people kind of came up with that theory. Now I've mentioned that, I mentioned quite a long time ago, I don't think halvings have much to do with anything. I think that it is a little bit of a fooled by randomness. Yes, it decreases the overall supply entering the system, but relative to the demand fluctuations, it's immaterial. So it's primarily demand driven, which is primarily news and liquidity driven. Okay, so that's something. I don't believe in the stock to flow model. I think stock to flow is nonsense. I've done some videos on that. The guy who invented the rainbow chart, Eric Wall, did a very interesting interview with the Defiant recently, where he was talking about how he made it up as like a funny meme joke just to show that it's nonsense, just like stock to flow, and kind of direct people away from there. So I wouldn't pay attention too much to that. What I would pay attention to is the underlying incentive structures within the markets, okay? So what have we got right now? Well, we have a world where the central banks and government, to some extent, have stimulated putting a lot of liquidity into the system. And so when you put a lot of liquidity into the system, that money goes somewhere, right? It is going to go principally into financial assets, and then to some extent, depending on the mechanisms, may go into kind of consumers. And then in this particular case, there was kind of a bizarre case where free money was given to people due to lockdowns, et cetera, people not having jobs, and then that money went back into financial markets. So there was a little bit of a two-way exchange that took place. So all of this, combined with hype, et cetera, drove up the markets a lot. Now, this begs the question of, are we likely to see the markets correct? Are we not likely to? Should you be expecting that things are going to go down a lot? What's your risk to return like, etc.? So here's how I look at it. What are the catalysts that would cause markets to drop a lot? The first one would be if there was a very rapid increase in price, which signaled a large amount of capital flowing into the markets, which was unsustainable and therefore would cause a crash on the other end, in particular if that was debt driven. We haven't seen that. So principally, that is not a major risk to the markets at this stage. I'm talking specifically about the cryptocurrency markets, okay? So that's one. The second thing that could be there is you could have some sort of environment that would cause people to sell and move their money to somewhere else. Now, certainly there is possible negative news, in particular on negative news, possibly on the regulatory side, right? So you could have regulations coming in that could spook people, they could pull money out, etc. That's to some extent a risk. The third thing that could happen is we could end up in a situation where there is simply less liquidity in general, okay? So what would require for there to be less liquidity? Well, people would need money from somewhere else, right? So it would get consumed somewhere, and I'm going to talk in a minute about where I see that happening, because I actually think that there's a counter narrative to the predominant narrative that people have, okay? So we've got that. The next side is that central banks and governments would attempt to pull things back, okay? So let's talk, before we do that, about the previous one, which is what would drive people to sell. So one is certainly coming into the end of the year, funds rebalancing could cause there to be, taking of profits and reallocating of money elsewhere. So that can create some selling pressure, which could have some downward pull. That should not be sufficient to cause the markets to go into a bear market. So it could cause some selling pressure, it might cause some pullback, but I wouldn't expect it to see an end of the current cycle. The second thing which could happen is people may have to sell in order to pay taxes, okay? So again, that could be interesting. Now, the thing that is possible from that standpoint, which is different this cycle than virtually any previous cycle, is in previous cycles you had to sell in order to pay taxes. There are some arguments that are made that the 2017 cycle top came about largely because of people having to sell to pay taxes, okay? That's one argument. The other argument is that people today, though, can sell or can allocate those funds into DeFi. They can borrow against them, they can take that liquidity and they can use that to pay their taxes without having to sell. So, that may cause less selling pressure than we've seen in previous situations, okay? So we'll see. It could also see a move of more capital into various different DeFi instruments, etc., which might see some sort of a pump in there. I don't know how extensive it would be, but it's a possibility, okay? So great. The more interesting thing, I think, is the idea that central banks and governments would cause their money to come back. And there's basically a couple different mechanisms by which they could do this. One is increased taxation. Now, certainly we're seeing globally an increase in taxation across a variety of governments. We're seeing something like the windfall tax that's been implemented or proposed in Malaysia, right? We've seen some proposals for windfall taxes elsewhere. We've seen rising taxes in UK on the corporate side, et cetera, right? So there's a bunch of different suggestions for more tax, which anytime you tax, you're taking the money out of the hands of people, which is going to mean there's less liquidity to go into markets, okay? So that's one thing. The second thing that could happen is government spending could decrease, which, to be fair, government spending amped up really aggressively, so pulling back that spending would not be an unreasonable thing, right? Basically, government spending adds liquidity to the markets, and so decreasing government spending reverses that process, right? There's less money that's going into the markets. The third thing is central banks could consider raising interest rates or doing tapering. And here's the way that I would look at that. Normally, the narrative has conventionally been that you're in a situation where they can't do it because it's not politically expedient, because if you're going to raise interest rates, that's likely to hurt the markets, and hurting the markets is bad for PR, et cetera. It used to be you could go back, say a decade or two, and there was a sufficient willingness to let markets go down. But nowadays, politically, it doesn't seem very expedient, meaning that politicians seem to be in a place where it's just not going to get them reelected to have markets go down, so they're just willing to do whatever it takes to prop up markets. That's sort of been the political environment. The kind of caveat to that, the reverse side is inflation. So I had a conversation with Warren Mosler not too long ago. He's the creator of modern money theory, for those of you who aren't familiar, very smart guy. And he and I were discussing, and I was talking about some of the moral hazard of allowing politicians to, centralized forces of people to print money. And he was agreeing on that. He said, yeah, that's indeed a problem. However, the thing that gives him reassurance is people seem to hate inflation more than they hate these other things. And I think certainly you can see this argument. So what's going on? We definitely have higher than normal inflation, right? Certainly inflation is running fairly hot over the little while. And it doesn't particularly matter what the causes of that inflation are. I've done some videos previously about how I would argue that the mainstream narrative around inflation, or maybe not the mainstream, but kind of the common narrative you'll hear, is inaccurate. But that doesn't matter, okay? It does not matter why there is inflation. The point is that people don't like that there is inflation. Now, certainly rising cost of living means people have less disposable income to put into markets, and so that in itself does decrease the amount of money that flows in, okay? So it decreases the retail involvement, and so you can have either inflation-driven recessions or you can have deflation-driven recessions. Both can function, okay? So we certainly have this inflation. This is certainly problematic, right? But the more worrying thing, I think, for sure, is that the inflationary pressures that are applied politically mean that politicians may do things that they probably shouldn't do or probably wouldn't otherwise do, okay? So if you're in a situation where you're getting a lot of pressure from the populace, and let's recognize that the problem going on here is that inflation hurts normal people more than rising markets help normal people, or more than falling markets hurt normal people, okay? Why do I mean by this? Well, the average person doesn't have a lot of assets. So if you don't have a lot of financial assets, you're not really benefiting from the markets being up anyway, and you're not really hurt that much by the markets coming down, at least not directly. You can argue there's a feedback loop which rolls into the economy, and you have jobs laid off, et cetera. You can make that argument. But that's not directly, that perception doesn't exist directly, at least not pre that happening, for average people. Average people do care a lot about their cost of living going up, right? That really affects them. And if you have a scarcity of financial resources, it affects you especially badly. And you're going to put pressure on politicians to do something. And so what are those politicians going to do as a result? Certainly in an inflationary environment, the instinct is not going to be to increase spending and to stimulate the economy, right? Even though you might argue, okay, well, one of the solutions is, hey, let's give a bunch more free money to people who have a shortfall due to inflation. Likely not going to happen, because the narrative is that's what's causing the inflation to begin with, right? So what it could lead to is, hey, listen, let's taper, right? Let's do a bunch of tapering. Let's raise interest rates. Let's go and basically deleverage the central bank balance sheets, et cetera, and try and reverse this. That's probably not a very smart thing to do because of some of the underlying supply issues that are driving at least an element of the inflation that's happening today. And so that's generally probably not very smart. But under political pressure, when things are emotional, when you're worried about getting reelected, when you're coming into a mid-cycle election in 2022 or whatever, et cetera, that's something that you might say, ooh, you know what? I think we actually want to do something about this. We need to make some changes here. And so if they do that, that could certainly signal the end of a bull market, the end of a cycle, kind of changing things over. At this point in time, they haven't done that. And so this leads me to the other part of the narrative that I think is worth understanding, which is money chases yield, okay? This is always the case, right? What you'll find within markets is things go up and people put money in because money is chasing yield, okay? When prices are down and there's high return on capital, money goes there, okay? So money chases yield. Well, where is the yield today? I mean, in the European Union, you have negative interest rates. That's not yield, that's anti-yield, right? If you look at bonds pretty much across the board, like a bond might be better than holding cash just because you get some interest, better than no interest. But the reality is that, especially on an inflation adjusted basis, bonds are yielding negatively across the world pretty much, Okay, so that's not good. Certainly in the Western world, in the US and like the major economies. So that's also not good. Then you can look at other options. Well, real estate is high, so you're certainly not getting very good yield on real estate. Definitely not getting, by yield I'm referring to cash flow, basically cap rates. So rental income to purchase price. So the rental income to purchase price ratios, because purchase prices have gone up a lot recently, are not very good, right? Then you can go and you can look at the stock market, and things are pretty high there. Dividend yields tend to be pretty low, right? So where are you going to go? By contrast, what is the situation? Well, yields in crypto are still quite high. And so my view on it is, so long as we don't see some sort of a major correction, and we might see some sort of major correction, which I think would principally be triggered by the inflation narrative spilling over into government and central bank actions, okay? I'm not so worried about regulations causing some sort of a major collapse. I don't think they'll crush the underlying economics. They certainly could cause a pullback. Certainly selling to pay for taxes can cause a pullback. Certainly rebalancing can cause a pullback. Not sufficiently, in my view, to cause the overall market to switch from being in a bull market to a bear market. It's more like a pullback as opposed to the other. In the absence of something major like that, the principal concern or the principal movement of funds in the absence of that concern would be that more money is going to go into crypto. And it's simply going to go there because of the fact that money chases yield. And over time, as more and more entities are able to make those investments, you can look at family offices. Family offices are increasingly interested in investing in crypto, investing in DeFi, etc. And so, look, if I can get 6% yield on my money, why would I do that as opposed to getting 0.6 or worse, 0.1% interest on your money? Somebody sent me on Twitter the other day an ad from Chase Bank in the US advertising, open a savings account for your kid. And it was like 0.1% interest. It's like you put $30,000 in there and you're getting, $30. It's like, great, enjoy the free lunch. Like, it's nothing. So if you can be in a situation where you can get, literally in this case, we're talking about if you were to go from that to 6%, 60 times the return, right? A dramatically higher return. And 6% is not a difficult return to hit. I mean, you're talking, people are doing much, much better than that. I've done some previous videos on it recently. That's going to attract capital. Now, that capital is obviously going to drive those yields down. Of course, that's the way that it goes. But it also is going to drive the markets up. So I would expect that over the next few months, barring something major, and something major could certainly happen, I would expect markets to continue to rise. And I wouldn't expect this to be the end. So that's a thought. I would love to hear what you guys think. Put the comments below. Share with me, do you think I'm wrong? Do you think I'm right? I would especially love to hear your reasoning. I think a person's position is much less interesting than the reason behind their position. So please share that. And if you liked the video, give it a thumbs up, share it with your friends. I'm going to look forward to seeing you guys on the next video.